How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to get into a report from the Federal Reserve Bank, basically called the Senior Loan Officers Opinion Survey. This came out last month in January. This is basically like a semi-annual report that the Fed puts out, and they really try to get a look at what's going on in the lending market. They do change the questions up a little bit, as we will see, and most of the questions are standard, but they do try to throw in a couple of things if they're looking for something specific. Again, we'll see here in just a second, but let's bring the report up here now. So this is coming from the Board of the Governors of the Federal Reserve System. So when you go to federalreserve.gov, basically you could pull this report up. And again, it's called the Senior Loan Officer Opinion Survey on Bank Lending Practices. And what I like here is that they kind of give an overview here, is what we'll spend most of the time on, where they basically go through, the opinion survey. Then they go into, lending to businesses, questions on commercial and industrial lending, questions on commercial real estate lending, and then they get into lending on houses, questions on residential real estate lending, questions on consumer lending, and then they get to special questions on banks' outlook for 2025. So it could kind of give us a little bit of information there, but then also at the top here, what I also like is they have a lot of charts here. So you have kind of like table one, a lot of options to choose from. Table one, table two, and then you could basically take just chart data. And then they also put these in PDF format. So you can get a PDF of table one, PDF of table two, and then a PDF of the charts. We'll look at a PDF of the charts here at the end. I'll pull that up just to kind of show everybody what that looks like. But let's jump into this for a second. So the January 2025 Senior Loan Officer Opinion Survey of Bank Lending Practices, also known as SLOOS, addresses changes in the standards and terms on and demand for bank loans to businesses and households over the past 3 months, which generally correspond to the fourth quarter of 2024. Regarding loans to businesses over the fourth quarter, survey respondents reported, on balance, tighter lending standards for commercial and industrial C&I loans to firms of all sizes. Now, if you don't know what that means, C&I loans would basically be lines of credits, term loans, equipment loans. Think of things like that. Anything basically outside of your standard real estate lending. Meanwhile, banks reported stronger demand for C&I loans to large and middle market firms, while demand for C&I loans to small firms remained basically unchanged. Furthermore, banks generally reported tighter standards and basically unchanged demand for commercial real estate loans. For loans to households, banks reported, on balance, basically unchanged lending standards and weaker demand across most categories of residential real estate loans. In addition, standards reportedly tightened for credit card loans and remained basically unchanged for auto and other consumer loans, while demand weakened for credit card and other consumer loans, but remained basically unchanged for auto loans. Further, banks reported basically unchanged lending standards and demand for home equity lines of credit. Now, I have reported in other episodes that it's not surprising that there's weaker demand for credit card and auto loans, and that banks have tightened up their lending, because we have seen that we're basically at an all-time borrowing highs for both those categories. Credit card debt's at 1.2, $1.3 trillion. But furthermore, we're seeing about 10% of credit card debt is currently rated as severe delinquency. So, we're seeing that at the moment. And credit card debt and credit card delinquency has also gotten very high. So, and then let's continue on here. So the January SLOOS includes a set of special questions inquiring about banks' expectations for changes in lending standards, borrowing demand, and loan performance over 2025. Banks reported expecting lending standards to either ease or remain basically unchanged, and demand to strengthen across all loan categories. In addition, banks generally reported expecting loan quality to improve for loans to businesses, but to either deteriorate or remain basically unchanged for most consumer loan types. So there you kind of have a basic rundown. Now, I'm not going to read through all the stuff here on the commercial, the C&I. I I would like to let's take a look at the commercial real estate here for a second, though. So, over the fourth quarter, modest net shares of banks reported having tighter standards for construction and land development loans, as well as loans secured by non-farm, non-residential properties, while standards for loans secured by multifamily properties remained basically unchanged on net. These responses were similar across large and other banks. Foreign banks reported that, on balance, standards for CRE loans remained basically unchanged. Yeah, and again, I think that is right on point too, because banks did see an increase in basically commercial real estate delinquency, and that basically, got them to kind of tighten up a little bit on things that they were doing and what was going on there. So, nothing real shocking there. Residential lending, again, we've talked about that a lot. Not really a ton of stuff happening there. But then let's take a look at these special questions for a second. So the January SLOOS included a set of special questions inquiring about banks' expectations for changes in lending standards, borrower demand, and asset quality over 2025, assuming that economic activity evolves in line with consensus forecasts. On balance, banks reported expecting lending standards to either ease or remain basically unchanged, and demand to strengthen across all loan categories. Banks also reported expecting credit quality to improve for most business loan types during 2025, and to either deteriorate or remain basically unchanged for most household loan types. Regarding lending standards, modest net shares of banks reported expecting to ease standards for CRE loans secured by multifamily properties, for GSE eligible residential mortgages, and for auto loans. Meanwhile, banks reported expecting standards to remain basically unchanged for all remaining loan types over 2025 on net. The most frequently cited reasons for expecting lending standards to ease, cited by major net shares of banks, were a more favorable or less uncertain economic outlook, an expected increase in competition from other lenders, an expected increase in risk tolerance, and an expected improvement and credit quality of their loan portfolio. Meanwhile, major net shares of banks reported expecting stronger demand for C&I loans to firms of all sizes over 2025. Significant net shares of banks reported expecting stronger demand for all CRE and RRE, residential real estate loan categories, as well as for auto loans, and a moderate net share of banks reported expecting stronger demand for credit card loans. So, among banks who reported expecting stronger demand, major net shares cited an expected decline in interest rates and expected higher spending or investment needs due to more favorable or less uncertain income prospects as important. Regarding expectations for credit quality, as measured by delinquencies and charge-offs, moderate or modest net shares of banks reported expecting improvements in C&I loans to large and middle market firms, all CRE loan categories, and auto loans to prime borrowers. In contrast, modest net shares of banks reported expecting credit quality to deteriorate to GSE eligible residential mortgages, and for all queried consumer loan types to non-prime borrowers. Credit quality was expected to remain around current levels on balance for all other loan categories. So, and I think this is, again, I think what's interesting here is that that's a good outlook, I think, for the most parts. Again, we're a month removed from this now. But I think what the key thing that we know now that we didn't know a month ago is that basically interest rates are probably not going to come down anymore, or they're not going to come down anymore anytime relatively soon. Right now, we're looking at things like Goldman Sachs basically has taken any interest rate cuts off the board completely for 2025. And Wall Street is basically betting right now that if there is any rate cuts, it's not going to come until probably the September meeting of the Federal Reserve at the earliest, and might even be more toward the end of the year, maybe even like November or December timeframe, if we get a cut at all. So we know that basically not much is going to change in the realm of interest rates. So, how does that ultimately, I think what a lot of bankers were thinking was that, hey, rates will go down more so toward the end of the year. We'll begin to see a bigger pickup. We'll probably have a little bit of shakeup with the changing of presidential administrations, and then things will kind of balance themselves out toward the end of the year. Again, we know interest rates aren't going anywhere, and we're already beginning to see kind of a major shakeup with the new administration, particularly as they focus on bank regulators like the CFPB and other players out there. So a lot of change going on there. So I think that how this year turns out is yet of a foregone conclusion. Do I see? I think a lot of the stuff in here is still going to hold steady? Yeah, I do. I think a lot. I think the credit quality will still remain somewhat steady. I do think that things will improve heading toward the end of the year. But as far as a big pickup in load demand or seeing certain things happen in certain categories, I don't know. I'm just not sure about that right now at this moment with what's going on with interest rates. So, but again, and just to look real quick here. So if you go to this PDF chart, click on this, and let's make this a little bit bigger so everybody can kind of see this a little bit better here. But so, and this is basically just 4 pages. It goes through all the different charts here, measures of supply and demand for commercial real estate loans, measures of supply and demand for residential mortgage loans, measures of supply and demand for consumer loans. So I really like the fact it gives you some really good charts, some good visuals to look at here. But a very good report that I love to look at just because, like I said, it gives you a little bit more information on kind of what's going on and what kind of demand you're seeing out there, how banks are doing their underwriting, whether they're tightening up or loosening, that kind of thing, and what products in particular are they more focused? Are they tightening up more on commercial real estate than C&I, residential, so on and so forth. So, but great report. Highly recommend everybody go check it out. There is a link to the report in the description down below if you want to go look at it. You can also go to the federalreserve.gov and you can find the report there. But that being said, I will wrap up by saying if you enjoyed this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, at Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. Hope everyone has a great day out there, and I'll see you again real soon. Thanks a lot.